Mehta buyback of shares. And none other than our Nupur, a partner from our New Bombay office, is presenting this time. And we have with our own panel, Mr. Bala, I need not to introduce, and Mr. Himanshu Kamdar, my and Atul's very, very old friend. I can say college friend and well-wisher. And you will be surprised, he's so down to earth. Even though my office told so many times to give his profile, he was not giving. He said, what acting profile, what it is. I am there, Himanshu Kamdar, partner-Rathi and associate. But I will say that he is there with Rathi and Associates since more than 30 years, right, Himanshu?
Yes, yes.
And since there, I think the kind of variety all over in the Companies Act and FEMA and all that, all experience, exposure he has. Himanshu, you can add it now. I think best is you can give introduction yourself.
No, my introduction, though I am a professional, rather recognized as a professional company secretary for more than 25, almost 28 years, but I continue to be a student. Genuinely, I continue to be a student, and that is how it has kept me motivated to continue doing good professional work, responding to the challenges of these statute and the clients. And that's it. I just see to it that I always keep my motivation alive to, read, reread, rethink, reinterpret, provisions. Each time it gives me a wonderful new aspect, new ambience. So that is how I just continue to learn, and I continue to share with my colleagues and my clients. That's it.
Thanks a lot. Most humble introduction. It's a correct thing. You have to read, learn, again learn, again learn. Every day, as and when you read 10 times, you get 10 more meaning and depth into the new aspect. Thanks a lot. So we have our Mr. Sailesh Bhai also with us. Good morning, Sailesh Bhai.
Good morning. Good morning.
With the topic, Mr. Himanshu, if I will say a few words on the topic, and then Mr. Bala, and then Nupur, you can start. So, what, Himanshu?
Yeah.
Or your few words on the topic buyback.
Sure. So the thing, friends, I am happy to be part of this webinar on buyback of shares. As you all know, this is my first experience of interaction with a gathering of very senior, learned fellow professionals outside the comfort zone of my office. So please bear with me since this is my first experience with you all, if there are any interruptions. Buyback of shares was first introduced in the Companies Act by way of Amendment Act of 99 by insertion of sections 77A, 77B and 77C, effective from 31st October 98. The SEBI introduced the regulations for buyback of securities by listed companies on 14 November 98. YT buyback of shares, buyback of securities regulations 98. The importance of buyback of shares as a management tool to reward the shareholders has gained momentum and importance among corporates over more than past 2 decades. This is evident from a small piece of data. As you all know, the COVID-19 pandemic knocked the doors of countries globally during the first quarter of 2020. During these 3 months, when the whole world was in dark about the impending and uncertain effects of this pandemic and its severe impacts on human life and economy, very, very astonishingly, about 17 companies announced buyback of shares. Companies such as Sun Pharmaceuticals, Supreme Petrochem, Dalmia Bharat, Granules India Limited, Emami Limited, among other companies, announced buyback of shares at premium ranging between 15% to 70% of their prevailing market prices, with a combined cash payout of more than 2,600 crores. So this underlines the importance of the buyback of shares as a management tool for companies all over India, listed as well as unlisted. In 2023, friends, we will be celebrating the silver jubilee of this very useful and efficient management tool of rewarding the investors and enhancing the brand image of company and its management. I am sure as the law and practice around buyback of shares evolves with more experience and innovations in financial markets, buyback of shares will assume more importance for the stakeholders, corporates, and regulators. As we all know, the management across India has been of many companies, listed and unlisted. They have been many a time struggling with the crucial decision to choose between dividend payment and buyback of shares. Many of us professionals have been called upon to help the senior management to understand the nuances of legal framework, procedural aspects, and short-term and long-term implications as both the options of rewarding shareholders on comparative basis. There cannot be a common or universally acceptable answer to this situation. It has to be customized to need of the concerned corporate and suitably address the prevailing circumstances related to such corporates, internally and externally. Therefore, it is of paramount interest for us professionals to be updated with various aspects which govern this mode of return of shareholders' equity. It has greater and far-reaching implications for the concerned company and its future endeavors. With this, I conclude my opening remarks, and I am really thankful to Dipti and Bala sir to provide me this opportunity to address you all. I may now hand over to Nupur.
Yeah, Mr. Bala, to few words on your part on the topic.
Morning to all of you. As you all heard that we have been continuously conducting the various webinars for the knowledge adding of the participants and also get ourselves enhanced our knowledge. This particular topic, I think we heard from Himanshu how important is the topic, what is the management is actually interested, what is the legal formalities are there, how we are well willing to reward the shareholders. Here what happens in the buyback, it can be done only by the companies which are having a cash-rich company. Because cash has to be going out. So cash-rich company is there. That is one of the important crucial matter on this. And the second thing is that, again, the capital restructuring can be done by the company they want to be. And after the buyback, what happens is the existing shareholders take increases in the companies. The person who is holding a share, suppose he is doing a certain percentage of the share, after the buyback, his tax automatically increases. He becomes more stakeholders in the company. And it is also from the company's point of view, it is better to service to the less number of shareholders rather than the large volume of the shareholders, etc. There is another aspect of it. So when the buyback concept was not there in the 1956 Act when what is introduced, as he rightly said, it came much later towards the end of 2000. I remember at that particular time, many of the old companies which were established much earlier, 40 years, 50 years, 60 years older companies and all this thing, after seeing this amendment, what they have done is, in the immediately ensuing annual general meeting, they took the enabling resolution of inserting in the articles, the buyback clause actually in the article. That is what they have done actually. Even the company where I was working, we also did the same thing. Immediately, you know, the press people, etc., is the company is going to buy back, what is this, and other thing, all questions have come at that particular time. Dipti also will recall this actually. So there are a lot of nitty-gritties in the buyback. There are various ways, method, procedural issue. As we go along, I think we will all get enriched. I'll hand over the things to Nupur to go ahead with the presentation. Over to Nupur.
Yeah. So good morning, everyone. Today's topic is buyback of shares. Coming to what is buyback. So buyback refers to the purchase by a company of its securities from existing shareholders. It can also be said that it is an alternative mode of capital restructuring and capital reduction. So buyback is controlled by the provisions of Companies Act 2013, that is by Section 68, which governs for power of the company to purchase its securities. Section 69, which refers to the transfer of certain sums to capital redemption reserve. Section 70, which says prohibition for buyback in certain circumstances. Apart from Companies Act, the Rule 17 of the Company's Share Capital and Debenture Rules 2014 also governs the provisions. SEBI Buyback of Securities Regulations 2018 also mentions details about the buyback process. So why does a company go?
And Nupur, I think FEMA will also cover if overseas investors will be there, no? Shares of.
Yeah, yes, ma'am. Yes, ma'am. So coming to why does a company go through a buyback process? As Bala sir rightly said, only a cash-rich company would go through a buyback process. With its excess cash, it prefers to share the cash with the shareholders rather than keeping it idle, and it is generally associated with the improved financial ratios, resulting to reducing the outstanding shares as well. So other benefits of buyback would be boosting the share prices in during the cases of sluggish markets. It improves the key return ratios like EPS, return on equity, return on assets, etc. Apart from this, utilization of excess cash can be reached in case the company doesn't have any prospective project to invest into. It is also a tax efficient method for rewarding the shareholders. It strengthens the promoter holding, thereby preventing the hostile takeovers. It also achieves an optimum capital structure and provides a best exit route for shareholders during the sluggish markets at a higher price. So what are the effects of buyback? As Bala sir rightly said, the main effect would be on the ownership stake of the investor. When, for instance, we'll take an example where a company has a share.
Nupur,
Yes, ma'am.
go a little slow. There is a request from participant. Be slow.
Okay, ma'am. Okay. Okay,
Yeah.
fine. Yeah. So we'll take an example of how the ownership stake increases. When a company has a shares of say 100 in quantity, the shareholder having 10 shares would own 10% stake in the company. And when after buyback, the shares, if at all the shares are reduced by 50%, the shareholder having same 10 shares would increase its ownership by 20%. The other effects of buyback would be the prices increase. So how the prices increase is that where the company calls for a buyback, it gives a certain higher price on the current market price. So, and the reduced volume of shares in the market, which reduces the supply, thereby the demand increases as a result of increasing the prices as well. Next, when the assets are reduced on the balance sheets, there is an increased return on asset ratio as well. When the reduced outstanding shareholders, the EPS increases and makes the financials healthy.
Mr.
Coming
Padu,
to-
would you like to say something on that earlier slide for little clarity, effect of buyback? Not this, next.
Nupur, could you
Yes.
go back 3 slides where you listed out benefits? That's right.
This one? Yes.
Yeah, that's right. Other benefits, you say it boosts share prices.
Yes, sir.
Now, we have always been debating whether it's useful to do a buyback. Why do a buyback instead pay high dividends? Now, when we pay very high dividends in a particular year, again, that would also boost share prices, no?
Yes, but then this would be a tax efficient method.
Okay, you're going to discuss tax afterwards?
Later.
Yeah,
Yes.
later.
Yes, sir.
It is
Yes.
coming
We'll
actually.
discuss that how it is beneficial than dividends.
Okay, fine.
And again, dividend will be 1 year effect. This will be having a long effect.
This is the long-term creation of the.
This is a long-term
Ratio improvement.
dividend for a year.
Yeah. Okay, please go ahead. If you're going to deal with taxation and taxation has a great bearing on this, I agree. Then the point is well taken. Please go ahead.
Silent by there is one more thing is also there.
What is there?
If you want to reward the shareholders,
Yes.
you can return the excess cash also to the shareholders by going the compromise and arrangement method.
Okay.
You enter the arrangement with the shareholders. Company doesn't need so much cash. The company wants to return the share to the shareholders. That is also there. But that will not be a long term. That will be a one time. Many people have done in the past.
But if Bala, would you say that if not for the tax benefits, which we have yet to see what Nupur has to say, if not for the tax benefits, would dividends not be a simpler method than buyback? Or this is a hypothetical question?
No. It is not the question of hypothetical. It is from the point of view the shareholders. What happens is the buyback is actually going to be a long-term benefit for them.
Long-term benefit. Yeah. Because
dividend will be for a particular year.
Correct. And would depend upon profits of future years also.
That is the thing.
Yes.
So here what happen, it is going to be a long-term wealth creation for them.
Correct, correct. One time, and all those benefits will be there for all time in future. You're right.
Correct, correct.
And when the shares are reduced, sir, the other returns are also increased, as in the financial ratios we can increase.
And not only that, your own shareholding, promoter shareholding, lot of planning is required. No? So many reasons will be there, which is the right question by Mr. Kamal here. It is not always to boost share prices. Recent example, TCS buyback. I think TCS is taking. Whether buyback is taxable, again, taxation also is taken later part of the presentation. We'll take all three questions, and you are right. It is not always to boost the price, share price, but many times it is also to correct the shareholding position of the product and many other reasons. And that's why I told Mr. Bala to comment on effect of buyback, that in this slide, that since the shares are bought back at a price higher than current, the reduced volume of shares reduces supply, and thereby demand rises, resulting into price rise. Buyback reduces the asset on balance sheet cash, for example, which leads to increased return on assets, and reduce outstanding share result in increased return on EPS. And also fourth is that it is used for correcting promoters holding and others particular shareholder holding. So that is also the thing. Yeah, Nupur.
Okay. So coming to the sources of funding, a company may purchase its own shares or other specified securities out of its free reserves, securities premium account, and proceeds of any shares or specified securities. So what does the phrase out of free reserves or securities premium account mean? In clause A and B, that is out of free reserves and securities premium account, they are not in the nature of money which is set aside or kept aside. So far as security premium is concerned, though at the time of issuing, it is received in cash, but somehow it is utilized by the company for its business purposes. Similarly, in case of proceeds of issue also, it is not kept in separate bank, and the monies are mixed with the company's other monies as well. And we can say it is also used up. So all the three accounts are basically used for appropriation, or we can say application of these three accounts for the issue of buyback. So the phrase conveys that there should be a sufficient balance in these three accounts or one or more of these three accounts to accommodate the value of buyback. And the second most important thing would be the company should have sufficient liquid cash to suffice the obligation of buyback. So coming to what all includes in free reserves. So it includes credit balance of general reserve and P&L. It includes realized capital profit, which arises from the sale of investment or fixed assets, dividend equalization reserve, dividend fluctuation reserve, subsidy received from government in cash, sinking fund. The second point would be securities premium account. When a company uses the security premium account balance, it has to adjust the expenses relating to the issue from which it has obtained the premium. And apart from that, it has to also make adjustments for the premium on redemption. And thereby the balance would be utilized for the buyback. So coming to the proceeds of an earlier issue. Proceeds of an earlier issue can be used only when it is not from the same kind of securities that are proposed to be bought back. As in, no company can buy back of any kind of shares or specified securities out of the proceeds of earlier issue of any same kind of shares or securities. That we can say that actually we cannot say that it would be absurd to say that equity shares were issued for the intention to buy back the equity issue. So that would be absurd. So we can say that proceeds from issue of bonds, secured or unsecured loans or convertible debentures may be taken up for the purposes of buyback of shares and vice versa. Now, section 70 prescribes certain circumstances wherein a company cannot buy back. So a company cannot buy back through any subsidiary or its own subsidiary company We'll take a case law on this later. So coming to the second part, it is that company cannot buy back from any of investment company or group of investment companies. A company cannot buy back if it has defaulted in repayments of deposits, interest thereon, any redemptions of preference shares or debentures, or any term loans and interest thereon. A company cannot buy back when it is defaulted in filing of annual return or failed to distribute the dividends within a period of 30 days or has failed to prepare the financial statements. It provides that the buyback cannot be prohibited when the default is remedied and the term of 3 years has been elapsed from making the defaults complied with. So next is buyback ways. So buyback can be done by the two methods, that is one by the board resolution and second would be by shareholders resolution. In both the cases, the articles must authorize the buyback. If at all the articles does not contain any provision of buyback, we could amend the articles and start with the process. So under board's buyback, there is a limit of 10% of total paid up equity capital and free reserves. And on the contrary, in case of shareholders resolution, the buyback limit is up to 25% of total paid up capital and free reserves. We should observe that this restriction is for the amount to be specified in total paid up capital and free reserves. Secondly, a company cannot buy back more than 25% of total paid up equity capital in a financial year. This consists the number of shares for calculation purpose. Coming to the modes of buyback.
There was a question that whether a company can buy back the shares without passing shareholders resolution. Yes, up to 10%. Yes, covered just now. Okay.
Okay.
But if above 10%, up to 25% shareholders.
Yes.
Yeah. Please go ahead.
So manners of buyback would be from existing shareholders on a proportionate basis, that is a tender offer we can say. Secondly, from open market. Open market is bifurcated to other two options as well. We'll cover that later. From odd lots and by purchasing ESOP sweat equity shares. There is a debt equity ratio to be maintained after the buyback. That could not be more than 2:1. The shares to be bought back should be fully paid up. There should be an explanatory statement annexed to the shareholders resolution prescribed under the section 68(3) of Companies Act, which prescribes all material facts are to be disclosed. The basis on which the price has been arrived, that has to be disclosed, and other material facts as well. So coming to the pricing of the buyback. So there are no prescribed methods to follow for the pricing, and we'll cover the valuation part later in detail. The buyback has to be completed within 12 months period, and a further buyback cannot be made within a 365 days period of time from this buyback. There should be extinguishment of shares, or the physical shares are to be destroyed within 7 days of completion of the buyback process. A further issue of same kind of securities cannot be made within 6 months period, except by way of bonus, sweat equity, ESOP, or convertible instruments. There shall be created a capital redemption reserve if at all the buyback is made out of the reserves and securities premium account, and an amount equal to the nominal value of shares are to be transferred to the CRR account. Nominal value, as in we can say if the shares are to be bought back at say 50 rupees, and if the face value of the share is 10 rupees, the amount of 10 rupees shall be transferred to the CRR account. Coming to the modes of buyback.
Now there is a question, Nupur.
Yes, ma'am.
Can company only do buyback of ESOPs from its ESOP holders at the exclusion of all others?
Sorry, ma'am, I couldn't get you.
Himanshu, Mr. Bala and Nupur, the question is, can a company do buyback only of ESOP from its ESOP holders at the exclusion of all others. Means buyback only from employees who are holding ESOP shares.
Yes, ma'am, we can
Yes.
do it. Yeah, sir.
No, you can do that. It is permitted.
Yes.
Permitted. Himanshu,
Yeah,
your view?
Yeah. I also agree. The fact is that the ESOP is always offered to a section of the investors who are the employees, directors, and eligible persons. So, of course, it can be done, exclusively by excluding the other regular shareholders.
Okay, thank you.
And the Companies Act process should be followed.
Okay.
Okay, so
Which would mean that we could have targeted class of shareholders.
Yes.
yes.
True.
Apart from
Absolutely true.
ESOP shareholders, what other class could be targeted? Promoter shareholders.
Yeah.
What other class
Yeah.
could you find?
Yeah. So, sir, as far as I know, there can be buyback of preference shares as well. So again, to the exclusion of the equity shareholders, you could buy back preference shares. So
No,
that is also
that's-
another example of
Okay.
targeted class of shareholders.
But within the equity shareholders, clearly we have ESOP shareholders and other shareholders. But could we
Yes, sir.
also have, say, promoter shareholders? Could they be a targeted? Can a buyback be made only for the purpose of to the promoter shareholders?
no, sir. Actually, this slide may answer the question. Actually, from listed companies, there are three types of offers. That is, first is tender offer, second is open market operation, and third is odd lot. And in case of open market and stock exchange process, the promoters cannot buy back, and in other methods they can buy back. But then it would be, detrimental to other stakeholders to purchase from only promoters. So promoters can go via tender offer or book building process. And even during the tender offer or the process of buyback, the trading window for the promoters are, stopped for the while. Yes.
So the only targeted buyback offer that one could visualize probably is to ESOP shareholders.
Yes, sir.
Otherwise, we don't see any separate classes.
Correct.
The question asks, do the employees have to convert ESOP into shares before buyback by the company, or the company can buy back ESOP without conversion of those into actual shares? Friend, it is converting in shares, it is buyback of shares. You can't do.
Yeah, you will not necessarily convert, because ESOP, once converted, then only it comes into the form of the securities. So without conversion, you cannot buy.
It is shares, so convert it into shares and then.
Yeah, but Bala sir, I just have a little bit of doubt here. You may kindly clarify. It talks of specified securities. So would not the options be considered as convertible instruments into equity? And from that perspective, prior to the exercise and the conversion of options into equity, could there be a buyback of the options? And I'm just since the topic is on, it's more of an academic, this thing query.
No, here the question is option once exercised, then only it becomes a security.
Then only.
Yeah.
Okay. So it's security has come to in place to affect the buyback.
Okay, sir. Thank you. Thanks for your clarification, sir.
There is need more clarity on selective buyback of equity. I think Mr.
Yes, correct. We require more clarity on selective buyback. Correct.
So, but selective in the sense promoter cannot, which Nupur answered. ESOP you can do it. So now the question arises whether I want to purchase a kind of shareholders only from Mumbai or kind of thing. That way I can do buyback.
No, third category, Dipti, could possibly be shareholders resulting from an amalgamation. That could be a different class. Because companies merged into this company and those shareholders are given shares of this company. That could be a different class. I don't know, but a little bit of study is required, I think. In this area.
I think there is Mr. Bala and Mr. Himanshu correct. Is there any prohibition that it cannot be purchased, except that it cannot be purchased, which Nupur has created slide. Other
Yeah.
than it can be, right?
My personal view would be that whatever is permitted expressly, within the realm of that only the buyback of securities could be done. Of course, the definition of specified securities needs to be considered while determining whether any selective buyback could be done. Because curiosity, as far as I am concerned, is also with respect to the odd lot, which is a kind of buyback, nature of buyback, odd lot. Yesterday also I had informal chat with Bala sir about odd lot. Unfortunately, due to paucity of time, I could not do much of a research on that. Because odd lot also could qualify to be a selective buyback, according to me. But of course, it requires more research and understanding. As far as Mr. Rajadhyaksha, query that shares arising out of the amalgamation or any restructuring, whether there could be any buyback of such securities from the shareholders of the transferor companies. I have my apprehension if there could be any such permission under the SEBI regulations.
It will be under scheme only, no, Mr. Raja, that amalgamation and all that entire structuring is done. No? So what it is?
No, I was just trying to see
As a resultant shareholder buyback, you are telling.
Yeah, and I was just trying to see whether those shareholders could be treated as a separate class. I was just searching for classes of shareholders. One was an ESOP shareholder, second was a promoter shareholder, third was shareholders resulting from amalgamation of a company. Just thinking aloud, that's all.
So it's a really ticklish issue, because once we say that this way, then a particular class of shareholders or a shareholders equality of treatment among same class of shareholders is a primary principle.
And one more thing here is that there may be an entity or an individual who is holding shares of transferee as well as transferor companies. So in such case, how could one differentiate between the number of shares which has been, which one holds, whether one which has come from the original issuer company or one which has arose out of the scheme of amalgamation? That also could be a little bit of a question,
True.
So
but I suppose that if you just did some calculations that could be brought out, because the exchange ratio, etc., would be there. Anyway, I think we have discussed this.
And it's a very interesting query and very relevant query, I should say.
So can we conclude that as per panel, the buyback of ESOP securities shares can be done as regards promoter, since there is a restriction, and as regards other class, the same required reading and the facts and the circumstances. Can we conclude that way?
Yes.
Yeah.
For the time being, at least.
Yeah.
Okay. Thanks, participants.
And just one small point, and Nupur, we need to be very sure from where we are saying that ESOP shares can be a specified class for the purpose. That means buyback is offered only for ESOP shares. Where it is provided in the law or the rules or circulars? That also could be part of the little work that could be done, research.
Okay, sir. Actually, the specified.
Sorry, Nupur, there is a comment again by the participant. SBEB and SE regulations 2021 allows buyback of ESOPs, and it does not give clarity whether the conversion of ESOP has to be done into shares. According to me, it is buyback of shares, so that's why conversion is necessary, according to me. Though Himanshu has also its different view. I'll leave it to panel just 1 minute. You can chat your review. Mr. Bala and Himanshu.
No, I definitely say unless the option is exercised, ESOP is converted to the share, no buyback can be done, because it is basically buyback of the share, not the option.
Yeah, not the option.
I have my little doubt, of course, I'll try and clarify it to myself and others, is that the regulation says buyback of securities, and of course, securities, we have the definition given under the, this thing, control, SCRA. So from that perspective, it's a matter of research for me personally. This query I would definitely try
And
to
we
answer
should
for
also
myself.
rightly mention what Himanshu you are telling, securities include ESOPs in SCR.
True.
Okay. So there is difference of view, but let's see. With that,
Not really a difference, it's just an extension of thought according to me.
yeah. Okay. I appreciate. Yeah, there is a question from Mr. Siv Kumar. Second proviso to section 68(2) states, provided that in respect of buyback of equity shares in any financial year, the reference to 25% in this clause shall be construed with respect to its total paid up equity capital in that financial year. Can this be explained by way of an example? Over to panel. The example of 25% of the equity share capital of that financial year.
Ma'am, I can say that if at all the share capital of the company is 1 CR and 50 lakhs are the equity share capital, so the 25% should be construed calculating the 50%, that is the 50 lakh equity share capital. Out of that, 25% shares are to be taken into consideration.
So post.
Yeah.
Is that clear? Or Mr. Sikumar? Anyone? Himanshu or?
Yeah. Actually, I'm still reading through this query. Second proviso to section 68 subsection 2 states, provided that in respect of the buyback of equity shares in any financial year, the reference to 25% in this clause shall be construed with respect to its total paid up equity capital in that financial year. Can this be explained by way of an example? Yeah, I guess Nupur has just stated the example. I agree with Nupur. Yes.
Okay.
That is the right interpretation.
Okay, let's go ahead.
Okay, so what are odd lots? So odd lots are the number of securities or shares, we can say, which is a smaller size than the marketable lot which is prescribed by the stock exchange. The process under tender offer and odd lot buyback is the same, and SEBI guidelines have prescribed in elaborate procedure regarding the procedure of buyback. We'll just take crucial and important features from these procedures. So for tender offer, buyback is made by a letter of offer to the shareholders in the format SH8. It is at a fixed price and on a proportionate basis, that is pro rata, we can say, on the existing shareholding in a fixed time frame. Again, the open market situation under stock market, it provides the exchanges having nationwide terminals via an order matching mechanism. We can say the daily trading system. And in the book building process, it is through an electronically linked bidding centers, and the price is fixed on the maximum bids that are received. So in these two cases,
no,
yeah, ma'am.
Slow. Again, participant is telling slow. Go slow.
Yes, ma'am. So in the open market scenario, in the open offer or stock exchange offer, we can say, and the book building process, there has to be a fixed maximum price, and between bids are received. And under tender offer, the buyback is to be made with a letter of offer to the shareholders mentioning the fixed price at which the buyback would happen, and on the proportionate basis and in a fixed time frame. So the next point, that is price, we have covered it. The time frame for the offer to be open would be 15 to 30 days in case of tender offer and in case of book building process. Under stock exchange method, that is the open market one, the time frame would be 6 months from the date of resolution. We can say that the book building process and open market operation, that is a stock exchange process, the prices are not too much, as in since the trade happens on the open market position, we can say that it is a slightly higher price than the current market. And on a tender offer, it would be a good margin for above the current market price. In case of board resolution buyback, the public notice has to be sent in newspapers within 2 days of passing of resolution. In case of shareholders resolution, the public announcement has to be made in the specified format 7 days prior to the buyback. There is a provision for preserving a 15% category, that is for small shareholders. SEBI prescribes that 15% of the securities that are
there is a question, 6 month minimum or maximum?
Maximum.
Okay, go ahead.
Yes. So there is a provision in tender offer. There are 2 categories, general category and small shareholder category. SEBI prescribes that 15% of the number of securities that the company proposes to buy back, they have to maintain this to the or preserve it to the small shareholders. A small shareholder, we can say, is someone who has shares worth rupees 2 lakh or less. Letter of offer has to be sent to the shareholders within 25 days of that of filing with the SEBI. In case of oversubscription, the tender offer process prescribes the pro rata buyback over the subscription. The completion of process would be that the verification of the tenders should be made within 15 days of the closure. The rejections, if at all, they are to be communicated within 21 days. If the rejections are not communicated, the offers are deemed to be accepted. There is a specified date concept, which is to determine the eligibility of the shareholders tendered the offer. It must be within 30 days from the date of public announcement. There has to be maintained an escrow account in case of tender offer and book building process, and an amount of 25% of the consideration of, suppose for example, rupees 100 crore, which is to be buyback. That for 25% up to 100 crores is to be maintained in the escrow account, and above 10 crore, 10% of the excess amount has to be maintained. The escrow account can be made in the form of cash or bank guarantee and securities in favor of the merchant bankers to fulfill the obligations. Promoters can participate in case of tender offer and book building process, but he cannot participate in the open market scenario.
Is promoter participation a must? Can he decide not to participate?
Yes, sir. Yes, sir. Definitely.
Yeah, of course. It is up to him whether he wants to participate.
It's up to him. Not that it is compulsory.
Yes, sir. Yes, sir.
Not at all. Not at all.
Okay. Also, we can say that major difference would be, for going through open market and tender offer, the promoters can decide or the company's directors can decide. If at all they don't want to go through the tender offer, they can go through the open market when the promoters do not want to participate and they want to, buy back the shares on a reasonable figure.
No, but as far as tender offer is concerned, the promoter may or may not participate.
Yes. Yes.
Okay.
Yes.
There is a question. Can you tender your shares for buyback if you are not a registered shareholder?
Yes, ma'am. But then you have to complete the transfer deed process.
So that means
that means a registered owner has to be, yes.
So we can registered shareholder. Panel, Mr. Bala and Himanshu.
Yeah. That is right. What she is saying, correct.
Okay, fine.
Yeah, because otherwise, on a lighter note, then the company will be obliged to remit the money to the person on register of members. Yeah. So it would be advisable to register shares, even from this perspective also, although passive investors, they would be advised to register shares in their name.
Right. Okay. Go ahead.
Coming to the trading system, under open market, there is an order matching mechanism that we can see on a daily basis, that is the daily trading system. And under book building process, there has to be appointed 30 bidding centers. Coming to the procedural aspects to consider. Regulatory aspects under Companies Act provide certain conditions, that is, you have to provide a declaration of solvency, that is in form SH9 with the ROC and the SEBI as well. This declaration must be verified by an affidavit to the effect that the directors have made full inquiry into the company, and they say that the company will not be rendered insolvent within a period of a year. The confirmation has to be made regarding that there are no defaults in repayments that are subsisting, that we have covered earlier as well. There has to be opened a separate bank account for payment of the consideration of buyback to the shareholders. There shall be no new issue of shares, including by way of bonus shares, till the closure of the offer. As in, during the offer period, the company cannot issue new shares, except for those who are outstanding convertible instruments. Regulatory aspects under SEBI prescribes that the consideration can only be paid in cash. The buyback through open market is restricted to 15% of paid up capital and free reserves. That is why a tender offer we can go up to the 25%. This is the next point which we have already discussed, that the trading window closure is there for the designated persons from passing of the resolution to the closure of the offer. And if the promoter intends to offer, he has to disclose all his transactions and holdings prior to 6 months. The company cannot buy back locked in shares or the non-transferable shares until they become free. The main intention of the buyback should not be to delist its shares. During pendency of mergers, amalgamations, or compromise and arrangement, there shall be no buyback. The company cannot withdraw the offer of buyback once it is circulated to the shareholders. Coming to the regulatory aspect under FEMA, the company must be eligible in automatic route, that is, it cannot be through the restricted sector. The pricing guidelines are to be adhered that are specified by the RBI. Form FCTRS with the relevant annexure are to be submitted to the authorized dealer. Again, the route is not available for financial sector as well. Coming to the tax aspect, which we already discussed. The company has to pay tax on the buyback, that is at the rate of 25%, as compared to the tax that is paid on dividend, that is 30% in the hands of shareholders. This means the buyback is exempt in the hands of shareholders. So we have discussed this.
1 minute, there are not discussed. Tax aspect, lot many questions. Now
Yes.
all the question is there. After tax aspect, what it is, your slide? Because many question is not taken.
Valuation.
Yeah, wait, valuation, one question is there, but other thing we can take it.
Okay.
Now, the last question from Mr. Kamal, what are the RBI pricing?
RBI pricing, I have not covered a slide therein, but it just mentions that the RBI guidelines are to be adhered to.
So, what are the valuation? Basically, valuation.
Yeah.
And any foreign exchange and RBI matter, you require a valuation.
Yes, ma'am. So I have prescribed in later
It's a
slides as well.
remittance overseas, so you require that valuation.
Yes, ma'am. So in valuation, I have covered one aspect of under FEMA as well. So I can cover it.
Okay, take it. Wait. Now tax aspect we have to take it one by one. Let's take it. Dividend are taxed at normal rates, which is not tax efficient. Buyback will definitely boost share price sometimes. Buyback on gain is also taxable. Capital gain booked on buyback offer attract tax rate lower than normal tax rate unless investor is in lower tax bracket. Our participants are very active. Mr. Ramana, thank you for all answers. Buyback is taxable for the company, however, it is exempt in the hands of shareholders. If the company has negative reserves, can a company buy back equity shares from issue proceeds of preference shares? I'll repeat the question, panel. If the company has negative reserves, can a company buy back equity shares from issue proceeds of preference shares?
I would say yes, ma'am, because there are the three options that either you go through free reserves or securities premium account, or the third process, that is proceeds of earlier issue. We can go through the same, yes.
No, but it is your buyback equity shares from the proceeds of preference shares, not the issue of equity shares, same kind. So whether buyback can be done from the proceeds of issue of another kind of shares?
Yes, ma'am. Yes, ma'am. Not the same kind.
No,
No,
Dipti, you're actually right. You cannot actually buy the proceeds of the same share buyback, but the different kinds of the proceeds you can you can go for the buyback.
Yes, ma'am.
Himanshu?
Yeah,
But Bala, does not your ability to buy back depend upon your profit position? The funds is a different matter, but profit, if you do not have profits, sufficient profits, can you do a buyback?
Yeah, Act is providing, so you can do it.
Yeah, from as far as I can understand, Rajadesha sir,
Yes.
the buyback of shares is not just for rewarding the shareholders from the surplus and the free reserves of the company. The regulations and the act gives a comprehensive kind of this thing objectivity to it, that the company may, because as far as this is concerned, the very manner in which it can be done by even way of proceeds from issue of different class of shares, that itself establishes the objective of the regulator, the government, that the buyback need not be confined to the surplus and the free reserves. There may be circumstances that management may think of doing the buyback for other purposes, or to face other circumstances like hostile takeovers or some such things, So from that perspective also, the company could go for a buyback of shares.
Yeah, Amit.
And if I'm not mistaken, it's not just that the preference shares, but the company could make issue of debentures also, if I'm not wrong,
Yes, sir.
which can be used, which can be
You're
used.
absolutely right. You're absolutely right, Himanshu.
I personally welcome Mr. Amit Gupta, who's one of our very learned friends, colleagues.
Hi, Amit, seeing you after ages.
Yeah.
Good morning, sir. Good morning.
Thank you.
I have had the privilege of Mr. Amit Gupta when we were on the Secretarial Standards Board,
My pleasure. My pleasure.
I recall.
I was just listening a very interesting conversation on this point. I have one small point. While I'll share my view on this particular point, what Dipti ma'am has raised. So as Nupur perhaps has rightly mentioned that there is no restriction as far as the buyback of equity shares from the proceeds of preference shares is concerned. There is nothing in law that prohibits. But I want to draw the attention to another area, and I seek the view of the panel. If I go to provisions of section 68(1), C, 68(1), if I can read, it says, notwithstanding anything contained in this act, but subject to provisions of subsection 2, a company may purchase its own shares or other specified securities hereinafter referred to as buyback out of its free reserve, the securities premium account, or the proceeds of the issue of any shares or other specified securities. So absolutely 68(1)(c) gives the answer to what Dipti ma'am has asked. I don't think there is any doubt left on this particular point. Now we just move a bit forward on the proviso 1. Provided that no buyback of any kind of shares or other specified securities shall be made out of proceeds of an earlier issue of the same kind of shares or same kind of other specified securities. So if I take a situation, let us say in the month of March 2022, I have raised a equity share capital of rupees, let's say 10 crore. In the month of June 2022, I want to do a buyback of equity shares. And I want to utilize the proceeds which are, you can say, available out of the issue that I have made in March 2022. So I am repeating that in March 2022, I have done the issue, I have utilized those proceeds. Now in June 2022, I am doing another buyback of equity share. I have reserves, I have other profits which are available, but I want to do the buyback. Can I do so? Or how you read this proviso 68(1)?
Sir, I just wanted to ask one thing. In March, you have issued equity shares.
Yes.
Yeah, and buyback of equity shares only in the same year.
So that cannot happen because, how can we say that, issue of equity share, the purpose or intention of issue of equity shares was to buy back. So that would be absurd. So we cannot utilize the funds out of issue of equity shares for the purpose of buyback of equity shares only.
Nupur, but if you read 68(1)(c), it very clearly says that I can come out with a fresh issue of shares. Let us first understand, if I want to now today buy back 10 crore of equity shares, can I make a fresh issue of equity shares and do the buyback? Answer is yes.
No, sir.
What is this meaning? 68(1)(c), the proceeds of issue of any shares or other specified securities.
Sir, I can say that the rules provide for other provisions as well, and the rule would say you cannot go for the same kind of securities.
Okay, all right. So
And,
maybe
according to me, that already you have raised the equity shares, and then at that time you must have mentioned the purpose for which you are raising the equity. Okay, now that cannot be that I want to buy back the shares. If you want to buy back, decide buyback, and then you can decide that I will do buyback from the fresh issue or whatever. That is the first thing, sequence also you can see. Second thing, it's very clearly written that if it is earlier proceeds of the issue of security. So it was earlier to buy back, so it is out. You cannot take it from the earlier issue, earlier to buy back. So that's why it is out to utilize that process. But you can utilize fresh process, and there they are not contradicting.
So let me, Dipti ma'am, I understand your point. Let me give you another perspective. In March 2022, I have raised 10 crore rupees, in which 1 crore was paid up share capital, 9 crore was securities premium account. And I presume that I have fully utilized, it was, let's say, for purchase of some plant or expansion, and I have completed that expansion. Now that 9 crore is lying in my securities premium account. I want to use that 9 crore for the purpose of buyback in June 2022.
I was expecting this question from you. I was knowing this will come when you use free reserve. Yeah, see, free reserve, it is there. It's a arbitrary now what we are talking. There's no clarity on this topic. Again, when you say that that you are utilizing for this. Sorry, panel, I am answering, you add on. It's panel privilege. I am arguing with Amit. Mr. Himanshu and Bala, please interrupt wherever.
No formalities, Dipti. Please.
Please go ahead. Go ahead.
So if I am taken the proceeds, I am parking that issue proceeds for certain purpose, since my purpose is not yet present fully utilized. It is still for that purpose we have to utilize according to my understanding. But still you can say in general reserve, everything is general reserve. You can put that way, but both arguments can be done, and according to me, stricter interpretation, it should be for the purpose you raise the issue, you raise the fund in earlier issue, and once you decide the buyback, your source should be then decided. Your earlier issue came up with particular purpose, so it should
that fund has been utilized for that purpose. It was for expansion, and I have utilized that 10 CR for that purpose. Now 9 CR is parked in a securities premium account.
Yeah, then it can be.
Then it can be.
Yeah. No, but I'm sorry to interrupt, but the words here are proceeds of an earlier issue. Proceeds. We need to put emphasis on this.
Himanshu, there is a securities premium separate head, that is 68(1)(b).
Yes, sir. I would say that securities premium account includes the issue of all the shares, debentures and all. But then considering the proceeds of the issue would include the securities premium also. And it has been categorized as the kind of shares. So we could include
we have to, proviso has to be read separately. And when we are on 68(1)(b), I think that has to be read separately. We have to create a distinction, as Dipti ma'am was rightly making a distinction. As long as, see, what my take is, as long as I have not utilized, let's say I have raised the 10 crore of fund and I have not put to use to expansion, and I'm still having the same money lying in my bank account. Can I use the same for the purpose of buyback? My straight answer is no, you cannot. Moment I have completed the purpose for which I have raised the money, and my money is lying in the securities premium account. Now that securities premium account can be utilized as per the provisions of 68(1)(b). I put it that way. Now when I am doing a fresh buyback, and now I am saying ki I need 10 crore rupees for funding this buyback, then I am making a right issue. I think that is the third situation, which in any case you are, me and you are in agreement, that can be perhaps done. There is no restriction.
Himanshu, your view, and Mr. Bala, your view.
My prima facie view would be proceeds of an issue becomes a deterrent in this case, according to me, because there is also one very small but very relevant query, that proceeds, whether it means money or reserves. No, really, that's many times.
No, Himanshu, I think we need to decipher between the two things. You are on proviso. I am on 68(1)(b).
Yeah, securities premium account.
Yes.
I would agree with you, Amit Bhai, on one fact, that securities premium account would have been built over a period of time, which would include your premium on issue of equity.
Maybe I'll say
premium on other securities also. I agree with that.
Period of time, it is just because of my earlier issue only, that was on March 2022. 9 CR is coming out of that, and I want to use that 9 CR only.
Say something here. Hey, Amit, I think you need to distinguish between the words that you're using: lying in securities premium account and funded. See, the amount is credited to the securities premium account. It doesn't lie in the securities premium account. It is used to fund the expansion, etc. And now, when you're doing a buyback, you utilize the amount which is lying to the credit of the securities premium account. And I would venture to say that once it is in securities premium account, and that B is not qualified with from where that securities premium account is coming, I think you could utilize whatever is there in the securities premium account.
Absolutely, absolutely. I'm in agreement with you.
But you need to make a distinction between lying in and credited to, because nothing really lies in. It is it is usually utilized very soon after the issue is made.
So,
And since B is standing by itself without any words after it, I think securities premium account is universal. That's humble submit. I don't know. I'm not sure whether I'm right, but
I tend to agree with the view what you have shared, because securities premium account utilization is governed by section 52. And 52 says that how your securities premium account can be debited. Securities premium account per se does not have any balance.
correct.
Right? Securities
It has a
premium
credit
account is
balance,
a
not
notional.
fund balance.
Correct. So you debit the securities premium account to buy back the quantum that you want to draw for the, from where you will fund, whether you
Yes.
want to borrow it money, whether you want to take any advance from somewhere, whether you
Correct.
want to raise the fresh issue, that's a different story. Funding will come from whatever place. I think that's not the question that is governed.
Yes, sir.
Create one.
Okay. Mr. Bala, any view from your side?
Yeah. See, as Amit puts it rightly, if the purpose is actually served, for which the capital has been raised from the earlier issue, if the money is actually lying in the security premium account, then the head of the security premium account is itself is mentioned separately one of the sources of funding. So long as the purpose is already served, the money is in the security premium account, then I think it can be used.
Okay, so we agree to that point. Now let's take another question, whether buyback will attract SAST if promoter holding increase from 24% to 26%.
Yes.
This
Yes,
is a
it will.
very important question. Very important.
It will.
Yes, okay. Next.
And one minute, let's take this question further. How will the promoter or the person who's holding 24% know that he has crossed 25? Will he suddenly be attracted with penalties?
No, he will not be suddenly be attracted. He is given sufficient time to reduce his shareholdings.
But who will tell him? Who will tell him that he has crossed? So there is to be responsibility cast on either the RTAs or the company to tell that shareholder, hey boss, you have now crossed 25. Kindly reduce or make an open offer.
Yeah, it is a company responsibility. Company is keeping a shareholding pattern and advising on quarterly basis to the stock
Yeah,
exchange.
they have with RTA that.
No, but there is no such.
Even after the process, the company has to submit the initial shareholding and
the result of
after
shareholding.
post shareholding also after buyback.
They are supposed to submit what is the initial shareholding before the buyback and what is the shareholding after the buyback. They will be anyway overcome.
At that time only they know that this will be the impact. No?
Yeah.
No,
Okay.
that is on the assumption that everybody participates in the buyback. It is prior to the buyback actually happening. But in the buyback, ultimately the promoter says, no, I'm not participating.
And then fine, no.
No, but then his proportion goes beyond 25%. Because of non-participation in the buyback, he is not taking back the shares. He's keeping his holding from 24 goes to 26. He doesn't know.
It's RTA and promoter has to take care.
But there should be
The
some
compliance
provision.
officer is there, so everyone.
I think some circulars, some provision in the rule should be there that in case anybody crosses these threshold limits, it is the duty of X party to inform him. And then he should act within 1 month.
It will come to company secretary only.
No.
Okay. Now let's say there is a Mr. Abhishek was the view that according to him, it will not attract SAST disclosure as it is not the case of acquisition. But we have decided, Mr. Abhishek, that it will SAST will be there. There is interesting question by SP that whether the buyback is a substitute for the physical shares. So I asked to elaborate. He says what happened, it is very difficult to demat physical shares. And he has physical shares with the name SP, whereas demat account is in the name of different name. To demat such physical shares, I have to give an affidavit with each demat request. Further, physical share will be held by senior citizens since compulsory demat from 2000. Further, there will be definitely be slight changing signature. I think it is company to company you have to request. So it depends on company. Now, there is a question, can we use special reserves without the permission of RBI for the purpose of buyback in case of NBFC? NBFC I have not covered, I think we have not covered. Any idea, panelists? Can we use special reserves without the permission of RBI for the purpose of buyback in case of NBFC?
In my view, no.
So if you create a special reserve, then that is for the particular purpose. How can you utilize that? You cannot.
So it will be RBI permission. Okay.
RBI permission would be applicable here.
Yeah.
Definitely.
Because it's not a free reserve really. It is created for a particular purpose. It's not
Right.
really a free reserve.
Yeah, so require RBI permission. Mr. Kamal, you can unmute and talk. I think you have raised the hand.
No. Dipti, I think even with RBI permission, you may not be able to do it because it's not a free reserve.
Okay.
There's no question of getting RBI approval. You can do it only with free reserves. A special reserve is for a particular purpose.
Correct.
So you cannot do it.
Okay. Okay. That is totally not allowed. Yeah, Mr. Kamal. Okay.
Yeah. Am I audible?
Yeah,
Yeah,
please.
very much.
Yeah, I have a question on the SST point of view. See, pursuant to buyback, the capital's total shareholder capital will reduced. So if a promoter holds 24% at pursuant to buyback, its holding went to around 26%, crossing the 25%. So whether the promoter is required to give the open offer under the SST or not, because it is not under exemption route, I think so.
We were talking about that 1 month period. No, I'm not too sure about the 1 month period, but
the point is that see, under SST, if holdings went from 25, if holding crosses 25%, it will attract open offer. Correct?
True, but then
if a promoter holds 24% as of now, okay, and pursuant to buyback, its holding pursuant to completion of buyback, its holding went to 24 to 26%. Whether it will attract open offer or not.
No. In the course of the discussion on this, somebody said that a period of 1 month is given to him to sell off his shares and come down to below 25%. If that is, I do not know who said that and from where it comes. But if that is the case, then he should exercise that possibility.
So also I would like to add that the promoters are to be given a, that if at all he wants to offer or something like that into the offer, he has to present a detail of transactions that he has, or the holding he carries for the past 6 months. He has to disclose it.
No,
So
that
then
is right.
we
That's
can,
the disclosure point. But the point is that whether pursuant to buyback, the promoter is required to give the open offer if promoter do not want to dilute the shareholding within a period of 1 month.
No. 1 minute only.
Yeah.
Here, as per the requirement, if shareholding cannot exceed 22%.
Correct.
And in this particular case, this has not happened with the acquisition, it has happened with the buyback. Incidentally, the shareholding has gone up.
correct.
So naturally, he has to find out the ways and means of reducing this shareholding to the level of 25% without making an open offer.
Okay.
For that, I think stock exchange has given a time. What is the time limit they have given? I do not know, but it is there.
No,
Okay.
So
It
he
is
has to reduce.
it's very
his-
fair that a time, some period should be given to him.
Yeah.
Vinay?
Yeah, please.
Yes, so regulation 10 of the SCST regulation specifies that if your voting right breaches the limit and you're required to make an open offer, then there is an exemption subject to you reduce your shareholding within 90 days
Yeah,
of the buyback.
correct. That is it.
Where is
That
this
is the
provision?
provision.
Where is the provision?
10, regulation 10, sub-regulation 3 of the SCST regulations.
It is there. Huh?
Yes,
It is there.
it's there.
So you have a
with-
3-month period to come back to normalcy.
Yeah.
90 days, yes.
90
To be
days.
more
Oh.
precise.
Yeah, there should be. There has to be.
Yes,
Mr. Kamal, it's clear?
Thanks. Yes. Thanks.
Thank you.
no problem.
There is a question. Is there any relevance of odd lot in case listed securities for shares held in demat account?
as we have already discussed, odd lot process is actually not into force, or we can say in Indian scenario, we do not go through the odd lot process. I just want a clarity with Himanshu sir. We've discussed this yesterday also.
Yeah,
If it is
yeah.
repealed or something like that.
No, I'm sorry to say, due to paucity of time, I couldn't do
Yes.
much of a research. But yeah, prima facie, my view is that with the demat of shares, the concept of odd lots has absolutely vanished. So from that perspective, of course, I hold my curiosity still intact. I'll do the research that how does the buyback of odd lot shares really occur, because I tried to see the history of buybacks.
Yes.
Unfortunately, I haven't come across one single instance so far.
Right.
So anyways, since it is there in the law book, definitely it would have some relevance. We just need to find something in substantial, to substantiate that.
Okay, next question.
But otherwise, odd lots per se, to as any kind of imagination, it has lost its relevance.
Yeah, over a period of time, after the demat has actually come, this odd lot concept is actually virtually gone up. Actually, I do not know. Even today, also everybody is holding the odd lot or something.
Truly.
And I remember particularly about 10, 12 years back, there was an odd lot window was operating in BSc and as well as MSc. Whosoever actually had the odd lot windows, etc., they can actually go there. They can actually dispose of odd lot through that window. That was actually the concept which was there earlier.
Correct.
Okay, next question. How to determine the BB price for private company? As per Companies Act 2013, Board of Director is authorized to determine the price. However, as per Income Tax Act and rules, it is necessary to obtain valuation report from merchant banker. Panelists may throw some light on this.
I would cover this aspect in the later slides, ma'am.
Okay, sorry, valuation you are doing this. Sorry. Okay, just specify. Can 15-30 days offer period can be reduced if offers are received incompletely with say first 5 days of offer?
To my mind, that is not permissible. That's what I can say. There is no such provision.
No provision, no?
No provision.
Because they have specified starting from 15 or 30, that 30 can be brought back. 15 cannot be brought back.
For other purpose, they have provided, but not here.
Yeah.
Okay. There is a question from Mr. Kaustubh. If the trading window will be closed for designated persons, promoters, during the buyback period, then how can they tender the shares?
Tender offer is via a separate channel, or you can say the separate process is there for tendering their shares. It is said that the daily trades they cannot make.
So this cannot be equated with the open market, according to me.
Yes. Yes.
It cannot be equated with the open market. The trading window is always applicable for open market transactions, dealings, whereas this is a regulated process. Buyback, which also covers the designated persons. So from that perspective, there is no contradiction.
Yeah.
Right. So that is why they are not eligible for the open offer.
Okay. Second buyback is proposed on 1st July 2022, after 1 year of first buyback. The buyback price is being determined based on a provisional balance sheet as at 31st December 2021, which is within 1 year of first buyback. Is it in a compliance with the rules?
Ma'am, can you repeat the question, please?
Yeah, there is a buyback which happened in first, I can say 1st July 2021. Then there is a second buyback proposed on 1st July 2022. Now the buyback for the second buyback, the price is determined based on a provisional balance sheet as at 31st December 21, which is within 1 year of first buyback.
So even this I would cover later, but then I can say, okay, for the purpose of pricing also, we could take audited balance sheet within 6 months time. And if at all it crosses the 6 months period, we can take a limited review report from the chartered accountants. I will cover this also.
If the audited balance sheet is actually within a period of 6 months time, yes, it is permitted.
Yes.
If it is beyond the 6 month period of time, you need a fresh valuation.
Yes.
So RBI pricing, you are covering later. What is RBI pricing? They are telling it is a valuation you have to do. RBI pricing means valuation as per the requirement of RBI regulation. Any transfer, any fund remittance, you require a valuation. Whatever is Act says or not says. Has taxation on buyback of shares undergone a change with dividend distribution tax is now out? Need to know.
Ma'am, can you repeat?
Whether taxation on buyback is changed with dividend distribution tax is not out, gone out now.
No, it has not changed. It is 20%.
No, buyback it is 20% is there actually. Whereas the dividend distribution tax is also there. Dividend distribution tax is higher, buyback taxation is less. That is why we are talking tax effectiveness.
Okay, there is a question from Mr. Ramamurthy. There is a long question from Mr. Abhishek. It will be difficult. I cannot make out. It's too long to take it up. So I'm taking Mr. Ramanamurthy. Buyback attract tax in the hands of company, but shareholders are still liable to pay capital gain tax on gains earnings. There is no question of exemption from tax in the hands of shareholders. Last year, I offered to pay tax on capital gains booked on TCS shares accepted under buyback. Need more clarity. Sorry, we didn't got it what you are asking.
Can he speak out actually?
So I can answer.
Yeah.
There is no question of capital gain in the hand of individual shareholder in case of a buyback. Buyback, the tax is determined on the basis of price, what is being offered in the buyback consideration, minus the price that the company has received from the shareholder. And on that, 20% tax is required to be paid, along with the education cess and the other taxes. There is no tax in the hand of individual shareholder, whether it is in form of capital gain tax or any other. So I think there is some understanding gap as far as the taxation issue is concerned.
Hello.
Yes.
Yes.
Hello.
Yeah, please.
Yeah, you see this Ramanamurthy here once again. This is the doubt I have. Although the buyback attracts a 20% tax in the hands of the company, I have been told by quite a few consultants and tax consultants, they say still the long-term capital gains or short-term capital gains earned on offer accepted shares are liable to be taxed in the hands of the shareholders. In fact, this is the doubt I had. I asked my CA also, he said, still you have to pay. Although the company pays no, from Himanshu, what he was saying, one of the panel members, sometimes I feel dividends attracts 30% tax, normal tax rate, whereas buyback attracts 20% in the hands of the company, plus the capital gain still attracts in the hands of the shareholders. That's why, but of course, now there's a view is coming, the tax capital gains in the hands of the shareholders are not liable to tax. This is something I get a conflicting views. If that is the case, this year also, I'm personally, I'm going to offer Gale shares under buyback. So there will be some capital gain will be there.
I'll put a relevant provision in the chat box.
Yeah, but I guess the taxability in the hands of the shareholders is absolutely undisputed.
Yes. So there is a,
It is
the question of exemption in the hands of the shareholder. That's what my question.
According to
Company has to pay tax on the buyback amount, and shareholder still has to pay capital gain tax. So in that case, dividends are slightly maybe tax efficient. I feel sometimes. So dividends such as normal tax, if he's under lower tax bracket, he still pays 15 or 20%. Matter is over. This is my doubt. Although it is beneficial for the shareholders because the shareholders gets a much higher price than the current market price. That is there. Gains are there for shareholders in the hands of in buyback. But from the tax point of view, tax is still liable to be paid by the shareholder. This is the view given by quite a few started accountants. I want a bit more clarity. That's why I pose this question again in the chat box.
Mr. Suresh Karla is telling not taxable in the hands of shareholders.
Okay, well, I don't know. Still, this is slightly debatable. Maybe Amit Gupta can clarify. I don't know if he is thorough with the regulations.
I'm already clarifying. I'll just
Okay.
put the clarification in the chat box. The relevant provision of the income tax
Okay.
very clearly says that it is not taxable in the hand of shareholder at all.
Okay. Okay. Fine, fine.
115 QA is the relevant provision by which the buyback is taxed. So there is no question of getting taxed as
Okay.
a long-term capital gain in the hand of individual, whether for a listed entity, whether for
Okay.
an unlisted entity.
Even a short-term capital gain tax? No, no tax. Okay.
No tax.
No tax.
No, nothing is actually taxable in the case of the buyback in the hands of the shareholder.
Okay. So this year I will not offer the tax on the capital gains booked on the GAIL, which I have just surrendered.
No, that's how that's how it is more attractive to dividend.
Okay.
Okay.
I'm now fine. Thanks very much.
Thank you. Does the proceed of issue imply money or reserves? We discussed this. Earlier issue means how many days, years earlier? Is there any clarification?
No, ma'am.
It's
As
earlier.
far as the account has balance, there
yeah.
is no provision. Yeah.
Only the amount equivalent to nominal value of shares needs to be used for the purpose, which is it has been raised. The share premium can be utilized. Okay. Utilization of value will have to be certified. Niti, in case of buyback in deemed public company, whether the company can proceed if only one promoter shareholder is offering tendering shares for buyback as on date of closure of offer period. I'll repeat, in case of buyback in deemed public company, you take it public company, whether the company can proceed if only one promoter shareholder is offering for buyback as on date of closure of offer period. Yeah. According panel, there is only one promoter shareholder who offered the buyback, no other one. Whether
within the limits, there is no problem.
okay.
As far as the proposed amount is considered that the company wants to invest, until that amount, it would be allowed, we can say.
There was a lot of question on promoter holding change due to buyback and open offer. We discussed that 90 days we have mentioned. Off-market transfer can be done at the time. Off-market transfer within promoter group can be done at that time or not in case of threshold exceed 25%. That time means what? Shiv Kumar, in case of private company having 2 members, can the entire payment of buyback be made to only one member if the second member does not want to participate and have no objection to pay to the first member? Basically, it's a shareholder directing that instead of paying me, pay to my agent or anyone. I think it is possible.
And there are a few uncovered or what should I say, not contemplated issues, but within the spirit and the objective of the provisions, one has to take a judicious view on such instances.
Fact of the case, yeah.
Truly. We have to only remain within the realm of the provisions. That's it.
Yeah, the one who has right to receive can also direct that to whom the payment can be diverted. But again, it has, as Himanshu rightly mentioned, take in the facts of the case and be judiciary.
Correct.
So if I can add just one line, offer has to go to both the shareholder of the private company. Of course, the other partner will not tender his shares. The tender offer has to mention the provision with regard to offer for the additional shares which remain untendered by the other shareholder. That's how it will work.
How do we determine the price of buyback in case of private unlisted company? Is valuation report mandatory?
In case of?
Private and unlisted company, how to determine the price of buyback?
Valuation report must be supported. That is.
You are taking valuation now, right? Yes. Sorry. while calculating, earlier point. 1 minute. You need audited accounts only. Okay, now you go ahead. There are valuation question, we'll take it. All tax question we have taken. Now take a valuation. So then you.
Dipti ma'am, I think one question is very relevant. In fact, I was also having in mind where the provision is with regard to the debt equity ratio. Somebody has asked, I think Mr. Shiva Kumar has asked.
Yeah, I thought that she's covering. It's covered earlier slide, Nupur.
What exactly, ma'am?
Even if covered, so I have a subposer. What is
the question? Shall we take the question then, Amit?
Yes, ma'am.
Yeah.
While calculating unsecured debts, should any statutory dues or contingent liability be considered to arrive the prescribed debt equity ratio, prescribed debt ratio? Panel. I'll repeat, while calculating unsecured debts, should any statutory dues or contingent liability be considered to arrive the prescribed debt ratio?
Yes, ma'am. I feel it has to be considered.
Panel, Mr. Bala and Himanshu.
Yeah, you need to consider, because ultimately, whether it is a statutory or otherwise, ultimately it is in the nature of the debt only.
Yeah. My view would be to consult the statutory auditors of the company on this. They would be, quite helpful to arrive at a conclusion on this.
Amit, your view?
So my question is also with regard to the same as to if you see, I'm saying practically, if you see the buyback offer letter, two things I could not understand ever. If you go to the SEBI website and get the buyback offer document, one issue with regard to this debt equity ratio, majority of the companies are taking only secured loan, secured debt for the purpose of this calculation. I don't know from where that understanding is coming, but invariably all companies are showing the ratios based on the secured debt position.
And SEBI is also accepting, no?
Accepting. So they are not raising the objection. So that means they are accepting. Second issue is with regard to the free reserve. If I go to the provisions of 2 clause 43 of the Companies Act, that clearly says that surplus in the profit and loss account is not free reserve. So you have to exclude that. But none of these companies have ever excluded the surplus in the profit and loss account in their calculation. Maybe their quantum is much lesser. They are doing a buyback of 1%, 2%, 3% only. So even if they exclude that, the buyback would be within the limit only. But point is on fundamental, whether it should
compliance is not there.
Whether it should be included or not. So I want the panel to deliberate, or maybe at some other appropriate time we can do some research and then come back with the appropriate. Means maybe either there is some understanding issue on our part, because SEBI, we can't say that they will be ignoring this particular provision. They are lensing everything, so they must be aware about this particular provision also.
Actually, you are right. Profit and loss account is not a free reserve at all, unless it is transferred to the reserve.
Absolutely.
So that is why the regulators are saying like that. If some people are doing it like that, okay, it goes unnoticingly, or otherwise the limit is much lesser and otherwise it doesn't make a difference.
Maybe that is one reason. And on the debt portion also, I'm saying the majority of the companies are doing the disclosure and calculations on the basis of secured debt only. Unsecured debt does not form part of the their disclosure document.
Though questioner Mr. Shiv Kumar asked specifically, while calculating unsecured debt, should any statutory dues or contingent liability? Honestly, I don't think practically anyone will do. And as regards contingent liability, since you are not quantifying, it is contingent. So I don't think that it can be considered in the debt, whatever.
Because contingent liability is the one which is depending upon the event when which it's materialized.
So that's why it should be out according to me.
Liability. So that is the different issue. But whether it is a statutory due or otherwise, whatever it is, debt is anyway, whatever is the debt.
Then the same way, if you take statutory dues, then take entire trade liabilities, any single penny due that way. And that is quite liquid form, so to calculate it will be difficult. So according to me,
I think there is a difference between the liability and the debt also.
exactly that point. I am coming that statutory due is liability, and that's a difference we have to make out. Contingent liability is liability, but not crystallized.
Correct.
If it is not crystallized, how you will include in that?
Contingent debt or contingent liability in any case will not form part. But as far as the statutory dues are also concerned, I understand statutory dues will also qualify as a liability only. They may not be tantamounting to a debt.
That exactly. Then you take trade liability also everything. So it is not that.
Correct.
Okay. Okay. Nupur, you can go ahead.
Okay. So valuation in respect of listed companies specifies there is no prescribed method again for coming to a particular price, and other factors that could determine price would be considered as market price, book value, or effect of the buyback on the EPS or return on net worth. The board has to determine the fixed price in the tender offer, and in case of open market operations, it has to prescribe a maximum limit or maximum price that could be reached to. Typically, it is a premium to the current market price. In case of unlisted companies, under the tax aspect, there is again no prescribed method, but then it mentions to the reference of Rule 11 UA, that is valuation of unquoted equity shares under discounted free cash flow method. It says that the reference to this rule has to be made, and this valuation could be made by a merchant banker. Initially, it was allowed for the chartered accountants as well, but now they have prescribed the merchant banker can only prepare this valuation. For transfer pricing, again, fair value considerations are taken into consideration. Under Companies Act, again, no prescribed methodology, but there should be a fair market value. And the disclosure of coming to the basis of arriving to the price is ordinarily supported by a valuation report. Under FEMA guidelines, again, RBI pricing guidelines are to be adhered. In this case, the valuation on arm's length basis are to be considered, which is duly certified by a chartered accountant or a merchant banker or a cost accountant.
If you observe, there is so much ambiguity. Company law says nothing.
Yes.
Tax says merchant banker.
Yes.
FEMA says chartered accountant or merchant banker register or cost account. So better you take merchant banker registered with SEBI, so you are safe with everything.
Yes, ma'am.
Actually, there is a suggestion from one of the participants to take a special session on valuation, because there are so much confusion on which valuation to be done from which and under which criteria.
Yes, ma'am.
Yeah, there is.
But all the regulations are talking fair market price.
Yeah, there is a comment from Devang Thakkar. 11 UA is to determine the price for calculation of individual taxes, not for valuation of company. Rule 11 UA.
Yeah, that's absolutely correct observation. Rule 11 UA is derived from provisions of section 56 to 10 of the Income Tax Act, and that is the anti-abuse provision. Anti-abuse provision means if somebody transfers the shares at a price less than or higher than the fair market price, the difference would be taxed in the hand of the receiver of money as a other income.
So, Nupur, your reference is rule UA is not correct. The valuation point is correct. Okay.
That is why it is mentioned that there is no prescribed method, but then we can refer
reference rule is wrong. Okay.
From taxation perspective, it is only.
Yeah.
Okay.
Okay. Go ahead.
So coming to the post buyback compliance, a return has to be filed with the SEBI and ROC, that is in form SH11. there has to be maintained a register prescribing the details of the securities bought back in form SH10 within the period of 30 days of completion. SH15 has to be filed, that is a compliance report signed by the directors, verifying that all the provisions of Companies Act and the rules have been complied with. Again, the CRR account has to be taken into consideration. The amount utilized and transferred to the have to be transferred to the CRR account, and the details of this transfer has to be mentioned in the balance sheet as well.
Nupur, in
Yes,
this
sir.
post buyback compliance, you could add one more point that
Okay.
in case anybody exceeds the threshold of 25% to take
Yes.
action within 3 months. That is
Yes,
a very
sir, yes.
important point, which
Yes,
is a
sir.
post buyback compliance.
Yes, I'll definitely add, sir. So coming to the e-forms, firstly, the resolution has to be filed with the MGT in the form MGT 14. Again, the filing of letter of offer is to be made in the form SH8. Declaration of solvency has to be made in the form SH9. And the return of buyback has to be made in the form SH11. Coming to the documents that we will require to be made. The certified true copy of the board resolution, buyback notice of EGM with the explanatory statement, certified copy of special resolution with explanatory statement, declaration of solvency, audited financials of last 3 years, auditor's report as certificate of declaration, details of promoters of the company, SH10, that is the register of buyback, that is about the description of the shares, particulars relating to the holders of the securities buyback, SH15, again the compliance certificate, the holders of securities before buyback and post buyback have to be considered as well. Coming to this point that we have already discussed, if the statement of assets and liabilities or the financials are not more than 6 months, so a limited review report has to be taken. So recent buyback was TCS, and it was offered of around 4 crore shares, and it was subscribed more than 7.5 times, and it was the 4th and biggest buyback in the past 5 years for TCS. Again, I have added one more point about the small shareholders that we have discussed earlier, that the SEBI rules have prescribed 15% to reserve it for the small shareholders, and TCS had offered 1:7 shareholding ratio for the reserved category. So ongoing buyback is GAIL, as Ramana sir rightly mentioned, and they have offered around 5.7 CR fully paid shares at a price of 190 rupees, and the offer closes soon, as in on June 7th. So Ramana sir, you could tender your offer. Coming to the penal provisions, if a company makes default in complying with the provisions of section 68 or the regulation made by SEBI as well, the company has to pay a fine of not less than 1 lakh rupees, which may extend to 3 lakh rupees. And in every case, every officer in default also, the punishable fine is not less than 1 lakh rupees, which may extend to 3 lakh rupees. Coming to the case laws, about Capgemini India Private Limited. Capgemini was the taxpayer. It had filed a petition with High Court seeking arrangement with the equity shareholders to buy back its shares under the previous act, that was section 391, compromise and arrangement, read with sections 100 to 103, which was about reduction of capital. So the regional director said that the taxpayer, that is the Capgemini, wanted to evade tax liability on the distributed income and to avoid the procedure followed under section 77A in the previous act, that is the buyback procedures. So the High Court rejected the objection made by Capgemini, saying that the regional director has requested locus standi to raise all objections pertaining to the taxation laws as well, even if the tax authorities do not raise any objection. On the contrary, in case of Sterlite Industries Limited, they have gone through the procedure of 391 along with section 100 to 104. It was decided that the company should either go through the procedure of buyback under section 77A or through the procedure of section 391. And the pertaining relevant section in the Companies Act 2013 was 23010, which says that buyback can be made only in accordance of the provisions of section 68 and not via any other methods. But since the section has not come into force, the ruling of in case of Sterlite Industries still prevails. The third ruling was that the law permits a company to buy back its shares in more than one ways, and it can opt for a particular method just to avoid the tax payment. As in, it was said that the taxpayer is always welcome to manage his affairs to avoid tax payment, and he can go through the other method for buyback as well. And it was legally permissible for this company to buy back following the procedure of compromise and arrangement with reduction of capital. And the fact that the same may not attract that much of tax would not be a colorable device. Again, on appeal, tribunal said that the concept of buyback of shares is different from the concept of compromise and arrangement in comparison with the reduction of capital as well. So we cannot equate the procedure of buyback and reduction of capital. Under Income Tax Act, the ruling was made that since these two procedures are different, the buyback of shares of corporate entity cannot be categorized as deemed dividend. And the buyback schemes could be taxed under the head capital gains and not deemed dividend. So in this case, the taxpayer was not liable to deduct tax under section 195. It was about the dividend distribution thing, and it could not be held as a taxpayer in default. Exactly contrary to this ruling, we'll take up a next case law relating to Goldman Sachs Securities. So Goldman Sachs Securities was an assessee. It was a wholly owned subsidiary of a foreign Mauritius-based company, Goldman Sachs. It was the wholly owned subsidiary, as in only one shareholder. So it had remitted an amount of 188 CR on the basis of buyback offered to the company. The assessing officer said that the premium on shares was nothing but the dividend, as in the distributable distribution of its accumulated profits. That was only to the ultimate beneficiary, that is GSM. So this was a colorable device to avoid the payment of dividend distribution tax. It was held that the excess payment of the premium amount was in nature of dividend, and since the assessee did not deduct any dividend distribution tax, it was taxable in the hands of the recipient company, the holder company, that is GSM. So in this case, since it has avoided the tax, the assessee was in default.
Nupur,
Yes, ma'am.
there are a lot many questions on SHA. Can you go to that slide? In case of 10% and 25%, what is the scenario of form filing of SHA 8?
Post compliance.
Go to that slide, no? Your SH8 filing. Lot of questions are there, so let's go back.
Not so much back. Not
No.
so much.
It is
You just skip. You just skip that slide.
Post compliance of buyback. Yeah, this one. I think so.
There's one more after this.
Actually, I have not covered SH8 in post buyback compliance. So
No.
Yeah.
Nupur, there is SH8
Yeah,
reference for letter of offer
Yes.
in
yes,
one of
sir.
the
Yeah, go
subsequent
back again.
slides.
Some
One
two
slide
slides
back.
later. after 2 slide it is there.
Yeah.
Take it there.
Where you have summed up all the filings which are required.
All the filing, yeah.
Yeah. Filing documents, forms,
Okay,
etc.
this
Yeah.
one.
Here
Yes.
it is. Here
Here,
it is.
Okay,
here.
okay, so yeah, got it.
No, but
This is pertinent. Filing of
where it
letter
is to be filed, you are covered, because there is a question when whether SHA is to be filed, because see, there is a question, if buyback is approved by board resolution, is it necessary to file form SH8? That is the question. Whether SH8 is required if buyback is within 10% limit and no shareholders resolution is passed, the same thing.
See, Nupur, the context is rule 17.2. If you go to 17.2, it says the company which has been authorized by a special resolution shall, before the buyback of share, file with the registrar of companies a letter of offer in form number SH8 along with the fee.
Yes, sir.
So this gives a very much clarity that it is
Yes.
required only in case of special resolution, where the case is within the limit of 10%. It is a board purview. Maybe special resolution will not be there. So question is whether SH8 is required to be filed.
No, sir, then I don't think it has to be filed.
Himanshu sir, any different view?
Yeah, I'm just reading through this sub rule 2. A company which has been authorized by a special resolution shall, before the buyback of shares, file with the register of companies a letter of offer in form number SH8 along with the fee. So it is always subject to an authorization by way of a special resolution. In case if the special resolution is not required, which is through the board of directors resolution, then the SH8 will not become applicable.
I agree with you. What you are saying is I agree with you.
But practically, I believe all invariably, I don't know the practice in Maharashtra, but practice as far as I know in North India, the registrars are insisting on filing of SH8.
Well,
Yes, sir. So we can say that in case of special resolution, it is mandatory. And in case of board resolution, it is recommended to file.
Recommended.
And it is a good governance.
Good governance.
The word would be mandatory versus arbitrary.
No. Recommended. Recommended. You don't want
it becomes
or to make it more realistic, generally, practice kind of generally. So something of that sort of course.
I was just trying to understand what is the practice in Maharashtra. I'm not sure about that, but at least I can say about the South and North, because we had dealt with one case in Bangalore ROC and many cases in North. So invariably all are insisting that you should file SH8, because unless you file, how I know about
what are the terms and all that?
Yeah. Amit bhai, the real issue here is, as far as my information.
Yeah, please.
Yeah, Himanshu bhai.
Yeah, what I understand is that SH8 per se addresses filing of the letter of offer. Okay. So from that perspective, as far as my knowledge goes, we do file SH8 attaching the letter of offer. And many a times the authorization by way of a special resolution is not really considered material for that. So from that perspective, to be on the safer side, although the sub rule 2 categorically states that the company should be authorized by SR, but still as a good corporate practice, we do file letter of offer, because the subject matter is the letter of offer, not the SR.
So as we say, it is recommendatory because it states all the details of the terms, and the registry wants to know what are the terms, though it is not questionable, board says prerogative, but it is recommended. We can put that, and the participants are also agreeing to our view, recommendatory.
And this is the beauty of a group of professionals coming together and then going through the intricacies.
Yeah.
In fact, invariably the company which are actually going for the buyback, they have been filing the letter of offer.
Yeah, we can say that because it's a terms of issue, so that's why.
Yeah.
In Maharashtra,
perhaps
the letter of offer it assets with SH9, then they approve the forms. So same thing, what we are telling.
No, I believe she's saying ki you need not file SH8 separately. You attach SH8 along with SH9. Okay.
In case of Mr. Silkumar is telling, in case of board resolution, no entity 14 is required. Then where is the question of filing any document with ROC?
Yeah, so here we can say that SH8 would be mandatory or preferred, we can say.
The SH9 in any case would be
To
required.
submit all the details of the letter of
rightly, Ms. Sadhana rightly mentioned that SH9.
SH9 in any case is mandatory.
So
Without
attach SH8 to SH9. Either file separately or attach it.
So
That is
if
the
I
right.
understand, I don't know, she can unmute and confirm if I understand correctly. So in Maharashtra, they are not filing or insisting on filing of SH8 separately. They are filing SH9 along with SH8 as an attachment.
Yeah, but either attachment or separately, people are filing SH8. That is the fact.
Okay.
Because everyone is doing that, because it's a part of it. Otherwise, also that is we generally offer that it's a letter of offer. So general practice is that way only, acceptable and recommendable.
I would like to understand one more practice, but once I think Nupur, you finish your part of deliberation, then I'll raise one more last point.
I think it is over, Nupur.
Yes, ma'am.
Yeah, she has already put it. She has already finished.
Yeah.
So, how you read the provisions of section 68? Let me just open so I can. 68 to C. 68 to C. I'll read the proviso. No, it is coming after proviso. 68 to. No company shall purchase its own shares or other specified securities under subsection 1 unless A. Buyback is authorized by its article. A special resolution has been passed at a general meeting of a company authorizing buyback. C. The buyback is 25% or less of the aggregate of paid up capital and free reserve of the company. Now, proviso comes and says that provided that in respect of buyback of equity shares in any financial year, the reference to 25% of this clause shall be construed with respect to its total paid up equity capital in that financial year. So my question is how you read and interpret the proviso, that is 68 to C proviso.
So it's a overall limit, no buyback overall limit. Your quantum of buyback should not cross the limit of 25% of paid up, aggregate of paid up and capital and free reserve of that year.
All right. 68 to C is straight. It says that aggregate of paid up capital and free reserve. And now in case of equity, what they are saying, total paid up equity share capital, equity capital in that financial year. So because there are different views prevailing in the different jurisdictions of ROC.
Yes, sir, yes. But what I come up through was that the point C says about the amount of aggregate paid up capital and free reserves for calculation. And the proviso says about the quantity of equity shares, or we can say number of equity shares should not be reduced below 25, above 25%. Yeah.
May I?
Yeah, please.
Yes, Jasmine.
So even in the recent CLC report that was issued, there is a point which specifically states, it's a clarification that they have made, that this proviso does not give a separate limit. It's just referring to how do you calculate the total paid up capital. You have to always add the amount in the share capital and the free reserves for calculating the 25%. So the proviso is no new limit. It's just stating that you have to take the equity paid up equity as on that financial year. It's just a clarification that was there in the.
So Jasmine, if I understand correctly, I have gone to the CLC report also that was released recently, it has added up further confusion, because it looks like they have a different interpretation with this regard. Whereas they have clarified only on one point, that free reserve would be added to the limit whenever you are doing a buyback, which in any case was very clear from 68(2)(c). Where was the confusion? Confusion was on the point whether 68(2)(c) provides the quantum of amount that you can use for the purpose of buyback, or it is talking about number of shares that you can buy back.
When you say paid up capital and free reserve, it will be quantum of amount only, no?
It will be quantum. So are we saying that there is no limit on the quantum? I can buy back as high as 90% of the equity shares.
But then there is a 10% and 25% limit for board resolution.
10% is board case. I am saying if 68(2)(c) is only providing the quantum that you can use for the purpose of buyback. Let's say I have a quantum of 10 crore and I decide to buy back at ₹10 each, and my quantum is coming to 90% of the total capital. Can I do so? Or can I exceed 25% of total number of shares? I have got 1 crore share. I want to buy back more than 25 lakh shares.
No, the 10 and 25% is very clear. You can't cross that limit. But the limit again, third additional limit is that amount cannot be more than 10%, sorry, 25% aggregate of paid up
So
capital.
from where that 25% number of shares is coming?
Yeah, Himanshu.
See, Amit Bhai, I guess, I mean, my view rather is that clause C deals with the number of shares which the company can buy back, not with the amount, because the wordings are very clear. The buyback is, now it only stops at saying buyback is 25% or less of the aggregate of the paid up capital and free reserves of the company, number one. And thereafter, because the proviso is actually incorporated to explain the situation, it says that provided that in respect of the buyback of equity shares, now the proviso has to be read in tandem with clause C, right? So here it says buyback of equity shares. So primarily the objective of clause C appears to be that of the number of shares read with this proviso.
Sir, can I add something?
Yes.
Yeah, please. Most welcome.
Sir, as far as the clause C is concerned, so it is the limit is regarding the quantum of shares amount that you can buy back, not the number of shares.
I agree with that, because both of them are just numeric figures in quantum. If you see paid up equity capital, not equity shares, and thereafter free reserves. Both of them are quantum.
As far as the proviso is concerned, so what it is saying that the shareholder can approve up to 25% of the paid up free reserve security account, and as far as the equity shares are concerned, then the limit will be only counted 25% of the equity shares. No free reserve and security amount will be calculated.
Correct.
That is the scenario.
Himanshu bhai, if I can add up to what Neil has just now mentioned. See, when you are, your paid up capital is built of equity as well as preference.
Yes, sir.
So if you are doing a buyback of, let's say, equity shares, let's say you have got 1 crore equity and 9 crore as a preference shares.
Preference.
10 crore, and assuming that you don't have any free reserve. How much you can buy back equity? The proviso comes into picture. It says you can buy back only paid up equity share capital.
Yes.
25% of paid up equity. So your
paid up equity will not be counted, sir.
No, so that's exactly what I guess. Then my view is that we can buy back only up to, if 1 crore equity capital, 9 crore preference, we can only buy back up to 25 lakhs equity shares. We cannot really take the
number.
Numbers. I am talking from the number perspective.
No. It is saying you can use 25 lakh rupees to buy back the equity shares. Now, how many numbers you will buy back, that will depend on the price at which you are doing the buyback.
I agree. I'm just looking at the number of shares which is to be capped, capped meaning the maximum number of shares. That is what I believe.
No,
Because
but
again, if your valuation, see, the assumption is that the valuation will be more than the face value.
Right.
Okay. The assumption is it will be the buyback price will be more than the face value. That is why there is this kind of confusion that what exactly to be considered. I guess I have a thought process in my mind, but I hope that I am able to express my thoughts correctly to the
Yes, sir. Yes, sir. I agree with you.
understanding.
Yes, sir. So for clause C, it is the amount aggregate that we have to consider, and for the proviso, the number of shares could not be reduced. So that is the case.
From where that view is coming, that proviso is about number.
So it says that the buyback of equity shares in any financial year. In reference to
it says in respect of buyback of equity shares in any financial year, the reference of 25% in this clause shall be construed with respect to its total paid up equity capital. As I mentioned earlier, in C there are paid up capital has got two components, one equity, one preference.
Right.
As the example I have given, 1 crore of equity and 9 crore of preference, total is 10. You could have buyback straightforward 2.5 crore. You could have taken money 2.5 crore for the purpose of buyback, right? Because it is 25% of 10 crore. But because your buyback is of equity share, you can use only 1 crore of equity capital into 25%, that is only 25 lakh rupees is available for the purpose of buyback.
Sir, I agree with you. I agree with you because recently I have gone through a company's buyback, and in that also the same situation happened. Company has a 5 crore of equity capital and 5 crore of preference share capital, and they are going for the equity share buyback. So when I calculate that limit now, so it should be 25% of the 5 crore, that is equity share capital only. Preferential will not be included.
I am in agreement up to this point. Now my worry is that because in many of the jurisdictions, like in to be very precise, the Bangalore ROC specifically has been interpreting that your number of shares cannot be more than 25%. I am not able to understand from where that limit is coming. I don't know about the practice in Maharashtra, so that's why I was asking, is there a case where you have made a buyback more than 25%
of number of shares?
I can give you number of cases.
So here the confusion is that 10% and 25% of number of shares or share capital.
No, that is for sure. It is the cap amount only. That I am having no doubt.
Then what is the confusion? The amount utilization.
No, the confusion is about the maximum number of shares which the shareholders are capable of tendering and the company is capable of accepting for buyback.
Correct. That's a confusion.
So it is number or capital, that is the point.
Because according to me, the buyback of shares provisions prima facie have the objective of ensuring two things. A, company does not accept more than 25% as far as the number of shares is concerned. Number two, the company does not pay more than 25% of the total liquidity through the paid up capital and the free reserves which is available with it. The basic objective is this. Both should be, what should I say, harmonized.
What you are saying was true up till 77A. The companies Act 2013 has a drastic change from 77A to 68. When we read the comparative provision, I think you will agree that they have maybe intentionally or unintentionally made a change in the language. Now that's where the confusion is coming. Under the 56th law, I am in agreement that 25% was a cap on the number.
For my understanding, as per my view, 10% of the share capital. So share capital it as a face value. So that you can purchase. Okay, 10% or 25, that is we know. the amount to be utilized for that should not exceed 25% of your aggregate paid up capital and free reserve. So face value plus premium, whatever you for because of valuation, the amount of buyback should not cross that 25% limit of aggregate of paid up capital and free reserve.
No, there is a slight difference, ma'am, in understanding. 10% or 25% both. 10% is within the power of the board. Let's say you have got paid up share capital and free reserve aggregating to rupees 10 crore. 10% becomes 1 crore. If your buyback quantum is up to 1 crore, you need not go to shareholder. How many shares you will buy back in that? No provision talks about. Similarly, when you come to shareholder approval route, that is provided.
That shares, they will not mention the reason that your valuation.
Yeah,
because they have kept the amount.
Absolutely.
Amount which
Dipti,
can be utilized for buyback. That's why they are not coming number of shares. Number of shares depends on your valuation. No?
It can exceed 25% also.
See, number of shares will not exceed.
But why? That is the point.
See, the 10%, your paid up capital is, I will not use crores. Your 100 rupees paid up capital. 10% comes 1 rupee. That through board resolution. 25 rupees through shareholder resolution. Now you are purchasing face value, no question. Find your aggregate paid up capital within amount that you can utilize. But if you utilize premium, in that case, the fund available for purchase of shares get reduced for number of shares because you are paying premium. But whatever amount utilized by the company will be kept by that limit of 25% aggregate paid up capital free reserve. Now, number of shares will be based on 10% and 25% of capital, paid up capital. Number of shares will not be there.
I think I'm not able to convey what I'm trying to.
I think we can take off the record now because it's 1 o'clock.
Offline I'll take.
Yeah, the act mentions capital, not shares. It's implied it's capital. The same thing I'm talking, but we can take it again, Amit, separately.
Yes.
This is 1 o'clock.
I think Amit has to have one-to-one conversation with Dipti.
Yeah.
Because when we are talking about the quantum, it is 100 crores, whether it is 1 rupee, 10 rupee, 25 rupees, that will depend upon the number of shares. Okay. So number of shares, nothing to do with that. It is only with the quantum. Anyway, Dipti, you can call him over a lunch or dinner. You can have a free discussion.
My privilege, sir. My privilege.
But I just wanted to add up. I finally agreed with Amit sir also, and I can say that the clause C is separate from the resolutions of board and special resolution. So we can say that the 25%, as you rightly mentioned, it both the provisions say about the amount. We can consider that it is restricted to the board resolution as well.
Okay, chalo. Now it's going to be confusion. More and more arguments will be there.
Slowly, we all are falling in line with Amit, I guess.
Yes.
I'm able to add some confusion to Mehta and Mehta.
Okay, thanks.
Anyway, Dipti was your lunch for you.
Yeah. Thanks everyone. Thanks Nupur for excellent presentation. Your in-depth study was visible from all the questions you are attending. That's really good. Your hard efforts is appreciated. Thanks Mr. Bala for all your support and contribution. Amit for your contribution. Himanshu, thanks for all your time and your contribution. And all the participants for your active participation. Thanks a lot. Keep on doing this. And I've seen so many questions are answered among participants themselves. Thanks a lot. Keep on doing things. And more participation is appreciated. And as usual, we will send this PPT to all the participants at the register address registered with us, email ID. And next session will be on the reduction of share capital. Be aware with us. Thanks a lot.
Thank you so much, ma'am. Thanks a lot for giving me this opportunity.
I can just do intimate. I do have a lot of issues on reduction. I'm just giving one heads up. you do cover, I think, the homework for Nupur.
Okay,
There are
sir.
a lot of companies which are struck off
Okay.
over a period of time, right? They are your shareholder. We want to get rid of those shareholder. Can we use the reduction of share capital route for the purpose of getting rid?
Okay. Okay.
Just do it as a case study. And
Okay, sir. Okay.
maybe whenever it is scheduled, we will.
Yeah, next Saturday it is there, Amit. Please attend.
Nupur, you're excellently done. Well, really speaking, I must really compliment, I must appreciate your efforts. You've done an excellent homework. Thank you.
Thank you so much, sir. Thank you so much.
Great
Thanks, ma'am,
efforts.
for giving me this opportunity with such eminent faculties.
Thanks, Himanshu.
Excellent. My pleasure. My pleasure.
Thanks, Himanshu bhai.
Thanks, Amit.
Most welcome. Most welcome, sir.
Thanks,
And
Thanks a lot,
I look
everybody.
forward to connecting with you all again very soon.
Yeah, anytime, sir.
And reduction of capital is an organic, thought extension again to buyback of shares. So I must compliment Dipti for that. Yeah.
Thanks a lot.
Nice to see you, Atul bhai.
Bye.
Thank you.
Welcome.
Bye.
Bye. Bye. Bye.